Welcome to the hardest game in the world. Unfortunately, you're playing with some of the sharpest, fastest, most intelligent, well-informed, stubbornly irrational, and in many cases, unethical minds in the world. You're up against a computer that can react faster than you, the trader who has more experience than you, the fund that has more money than you, the insider that has more information than you, the others that will misinform you, and the inner voice that will do its best to undo you. So, leave all of your dreams of making quick and easy money behind. The first aim is survival. Your absolute first goal is to learn how to stay in the game. And you can only do this by mapping the territory, by understanding how the enemy thinks and acts, by having a solid game plan, and by picking your battles very, very carefully. Ready to play? Now those are not my words, those are the words of an infamous trader called Tom Dante, who some of you may have heard of, and I don't think I could have possibly said it better myself. And it's a very apt way to begin the risk management module with. Because as you may have probably heard already, there's an infamous statistic that loves to get thrown around, which, I'm not entirely sure how accurate it is. But as it goes, it says that roughly 90% of retail traders lose 90% of their capital in the first 90 days of them opening an account. Now, the number one reason that this occurs is due to the absence of any risk management combined with the abuse of leverage. Period. So I'm going to teach you sound professional risk management principles that have stood the test of time and will make sure that you do not become a part of that 90-90 rule like the masses. So although you are a financial trader, your job first and foremost is actually one of a professional risk manager. This is the concept that many continue to get wrong. In speculative trading, protection of capital takes priority over optimization of profit. A bulletproof risk management regime is paramount to any successful trading strategy. Even the best trading strategy in the world can eventually put up your account if it is not integrated with strict money management principles. So when new traders enter a trade, their primary thought is often, how much money can I make from this trade? But potential profits are seductive. The first question a professional trader asks is always, how much money can I lose on this trade? So your three objectives as a trader are to conserve capital, generate an income from that capital, and then in turn increase your account size. Protecting your capital must be your first priority, because if you still have capital, then you can survive to fight another day. Capital will keep you in the game. Now, I've known a number of traders who are brilliant technical analysis, but yet they still lose money due to their lack of respect for risk management. The market will always humble you. Market conditions, they're not always going to be optimal 100% of the time for individual strategies, and there are times when choppy corrective price action can result in a series of losing trades. So if your focus is to protect the money in your account during those choppy market conditions, then you're going to remain afloat to rebound from these losses and then make new account highs once the market conditions become more conducive to your strategy again. And this module is dedicated to highlighting the various risks that you are likely to face as a trader. And by implementing the risk management principles we're about to cover, you will increase the probability of protecting your capital and therefore of not only becoming a successful trader, but actually maintaining that success over the long term. So, what is the golden rule in trading? Well, a major key is to never risk more than 1% of your trading account per trade. Never risk more than 1% of your trading account balance per trade. Why? Well, by capping the risk on each trade to 1% of your account, you increase the probability of your survival during those unfavorable market conditions. And in the unlikely event that you manage to lose 10 trades in a row, at a capped 1% risk per trade, you still have more than 90% of your initial balance left to trade with. Drawdowns like this can be made back with just one trade, and new account highs may be achieved once again. Right, I want you to think of a submarine. And now imagine that the internal rooms of that submarine have been completely hollowed out, so now it is essentially just one big giant hollow floating tube. If that sub was then attacked by a missile from an enemy ship, what do you think would happen? Just a single blow would cause it to fill up and sink immediately, right? Now take that same submarine, but this time build strong dividers so that it now contains 100 watertight compartments, all in equal size. If the sub was attacked again by an enemy ship, now what do you think would happen this time? Only one of the compartments would fill up, leaving the other 99 intact to keep the submarine afloat. So the submarine could take hit after hit before sinking, and giving it enough time to escape enemy fire and return to safety and live to survive another day, right? So with this anecdote, think of your trading account just like the submarine, right? By capping the risk to 1% on each trade, you're essentially dividing your account into 100 equal positions and accept a maximum loss of just one compartment at a time. And this survival technique is critical in keeping your account alive long enough to then enjoy the calm blue waters of profitable trending conditions. You know, some amateurs think that they're being sensible by risk managing by only risking 10% per trade. But you can clearly see that it's only going to take a few hits to their account and suddenly they're going to be underwater very quickly. Others might be a little bit more prudent and think that 5% risk per trade is okay. But look at the protection that 1% risk per trade does for your account. You can clearly see that this is how you remain in the game for the long term, so that you can survive the inevitable run of losses that you will string together over the course of your trading career. Not only does a 1% risk model actually preserve your capital, but during a series of losses, the monetary risk on each trade, that actually becomes progressively smaller and smaller, and it forms what's called a reverse compounding effect. In the previous lessons, you saw how consistent profits become progressively larger as a result of compounding, but the inverse is also true. During periods of losing trades, your losses will progressively get smaller. So the simple act of risking a fixed percentage per trade, it ensures that your account harnesses the power of compounding on the way up, whilst also taking advantage of the reverse compounding effect during those periods of drawdown. So during periods of account drawdown, that 1% risk model, it forces your risk to progressively get smaller and smaller. Sounds pretty logical, right? Yet most traders do exactly the opposite. Systems such as the martingale, it actually encourages traders to double their risk after each consecutive loss. So if they risk 1% on a trade, but then they lose that trade, they then decide to risk 2% on the next trade to try and make it back and more. But then if they lose that second trade at 2% risk, they're now down 3% overall. So instead of learning their lesson, they think they're smart and they decide to double down their risk again on the third trade, and they're now risking 4%. But they lose 3 trades in a row, which is perfectly normal, by the way, and even expected, even with a high win rate. But now they're down minus 7%. But they continue the gambling system, doubling their risk to 8%, losing again, and putting them in a huge hole of minus 15% to climb out of. So they roll the dice one last time, and they double their risk at 16%, and they finally get the massive winner that they were after. But look, their total P&L is now only 1% profit. So they assumed all of that massive risk, well on the way to nearly blowing up their account, just to make 1% profit. That is obviously not smart trading, because their risk far outweighs the reward every time. Now, gamblers love systems like the martingale because it allows them to buy into the false belief that they'll get away with never fully realizing a loss. Potentially in a hypothetical environment of infinite capital and infinite market liquidity, that theory may hold water. But in the real world, it's pure fantasy and a sure way to blow your entire account. In the early stages of your trading journey, the golden rule will be your main way of avoiding risk, because you are eliminating the risk that is you. When you are yet to reach consistency, there's going to be a learning gap. I am here to fill that gap in the most efficient way possible by teaching you exactly how we trade, how to apply our strategies, and how we manage positions and how we manage risk. So your learning curve is rapidly shrunk, but you will still have to work extremely hard at it to reach that consistency. And that golden rule is what is going to protect you in the meantime. So drawdown is essentially the reduction of your capital after a series of losing trades, and this is calculated by the difference between a relative peak in capital minus a relative trough. Now, although account drawdown is a very normal occurrence while trading, all measures should be taken to keep it as small as possible. And the best way to do this is by keeping the risk per trade to 1% or less of your account. And the reason that this is so important, and what a lot of people don't realize, is that recovering a loss is mathematically harder than making the loss in the first place. So if you were to start with a £10,000 account and you take a full loss of 1% so that you lose £100, then your account will fall to £9,900. This is also referred to as being in a 1% drawdown. At this new account balance of £9,900, if you make a profit of 1%, you will now only make £99. So this only brings the account back up to £9,999. You're £1 short, even though you lost 1% and you made back 1%. Now, this small difference could appear pretty negligible at first, but as the drawdown percentage increases, it becomes ever harder to recover losses. 10 to 20% drawdown can be quite easily recovered, but beyond this level, it starts to become far more difficult. Here is a table showing the drawdown versus the profit recovery rate required just to get back to break even from where the drawdown started. So if you experience a drawdown of 5 or 10%, you pretty much just have to make 5 or 10% back. But once you start to lose over 20% of your account, you are really starting to tread in deep water. The more you lose, the harder it is to recover. And this is the primary reason that we cap our losses at 1%. Because if you're in a situation where you lose 50% of your account, you have to double your money just to get back to where you started. When you risk too much and lose, your chances to recover your capital fully are very, very slim. And it's not only because you are merely left with much less money in your account, but you also have to deal with the negative psychological impacts of those drawdowns. And that can be a very vicious cycle that is extremely hard to climb out of. I really can't emphasize enough at just how important risk management is for your long-term success in trading. You have to take it very seriously and be extremely disciplined, right? You have to be professional. And here's a table that shows what effect a losing streak can have on your account depending on the level of risk that you choose to take. So when you're first starting out in trading, it's pretty much an absolute certainty that you will experience some extended losing streaks until you gain some more experience within the markets over time. And this table clearly shows how important the difference that risking only 1% per trade will make. Because it's extremely likely, at some point in time, you will lose 5 or 6 trades in a row, which is completely normal, by the way. And if you are only risking 1% per trade, it's extremely manageable to get back out of that drawdown in just a few trades and make back that 5 or 6%. But if you've risked 5% per trade, you've now lost around a quarter of your account. And if that happens, you will now have to put out a huge return of almost 40% just to get back to break even. This is insane. Do not trade like this. You can clearly see how absurd it is to risk that much capital on a trade, and your risk of ruin is extremely high. It's a near certainty. You can blow your entire account within a month with relative ease. And even if you are a more experienced trader who is relatively consistent, it is still almost a certainty at some point in time that you will experience a string of losses for whatever reason. As I said before, the market will never fail to surprise and humble you. Because here's a table that shows the probability of you losing a number of consecutive trades within a 1,000 trade sequence, depending on your strike rate. So your strike rate is just another way of saying your win rate. So let's say you're actually a pretty good trader and you've got a strike rate of around 60%. This table shows that it's almost a guaranteed certainty that you will experience at least 6, if not 7 losing trades in a row. It's a certainty, it's guaranteed. There's no way around it. It's just a mathematical certainty. Now, hitting 8 losers in a row has a 50% probability, so the same chance as flipping a heads or tails in a coin toss. If you lost 7 trades in a row at, let's say, 5% risk, you've got to make nearly 50% just to get back to break even. Anything lower than a 60% strike rate, and you can see just how likely it is that you will experience a large string of losses, and that's only just in a 1,000 trade sequence. If you are in trading for the long term, over the course of your career, you will no doubt take thousands of trades. And all of those probabilities in that table will then shift along to the right. And even if your strike rate is very, very good and pushing near 70%, you will still be at risk of stringing together 6 to 7 losers in a row at some point. It happens to the best of traders. Anything can happen in the markets. Anything. So make sure you respect that and keep your risk management principles in place so that you can survive those bumps in the road, so that you only need a couple of winners to get you back in the game and making new account highs once again. All of your trades should end in one of 4 ways: a small win, a big win, a small loss, or a break even. You should never ever experience a big loss. If you can get rid of big losses, you have a great chance of being profitable for years to come. Small, regular profits are key. Remember, your focus the whole time should be on you becoming the asset yourself. You may not have access to a lot of capital right now, and that's okay. Be the best trader that you can be with what you have now. Build those solid foundations now with tight risk management principles. And if you can do it now on a small account, then you'll be able to do it on a large account. You have to prove that you are worthy to handle and manage that larger capital. So having what you may consider to be a small account is no excuse whatsoever to risk more than 1%. Because if you can build a track record with small consistent profits, with minimal drawdown, then you'll have no problem finding big investors. You'll have no problem getting funding. Because remember, investors care more about drawdown and potential loss than the upside potential return.